Hi, this is Brian with Leelyn Smith in your Q3 2023 Outlook. And remember, at Leelyn Smith, we try to reach client goals with the least amount of risk possible. Okay, this video is one I wanted to do for a long time. And it's important because it can really help understand market investing more. Timing is good because we have a tightening monetary policy regime that is coming to an end, but there's a lot to cover in a short amount of time. We are going to cover the business cycle and the market cycles, two items that are typically confused, but if clarified, can really help demystify stock market investing. So hopefully I can cover them in a short amount of time. I'm going to jump right in. So the business cycle is where we're going to start. The business cycle, sometimes referred to as the economic cycle, is concerned with the broader economy, not just the stock and bond markets. It's employment, inflation, real estate, and so on. There are a few different ways of classifying the business cycle. We use the traditional four-phase approach, and those four phases are the early, the mid, the late, and then the recessionary phase. Only the fourth recessionary phase is contractionary. The first three are all expansionary. Now, the early stage lasts about a year on average. The mid-cycle phase lasts about 3.5 years on average. The late cycle phase lasts about 1.5 years, and then finally the recessionary phase lasts 9 months on average. Now, moving over to the market cycle. By market cycle, I'm referring to the stock market. The market cycle also has four distinct phases, which are typically driven by large financial institutions such as pensions and mutual funds. The market phases essentially identify trends as buyers and sellers move in and out of the market in waves, which is reflective of the business cycle. Now, what's important to know here is that the market and business cycle are not necessarily working in tandem, but they are related to each other. So how are they related and where are we now? Currently, we are in the late phase of the business cycle. The market cycle considers the business cycle, but also considers potential future developments to arrive at reasonable expectations. That's why we have analyst forecasts. The key is that the stock market is about a year ahead on average of the business cycle, and that's because earnings expectations are done a year ahead or 12 months out. So at times, it seems as if the market doesn't make sense because there may be some business cycle development that you would expect to impact the market in one way, but it impacts it the other way. So we are currently in this tightening monetary regime policy that the Fed is partaking in, and this year we're actually having a pretty good stock market. Why is that? Well, last year, when the Federal Reserve announced the regime and started the rate hiking, the stock market reacted and went down. This year, remember, analyst expectations are about 12 months out. So when the Fed started last year, expectations came down. This year, it's expected that the Fed will stop their rate hiking, pause, possibly even start decreasing interest rates, which would be positive for stocks. So we're starting to see a year ahead, analysts getting a little more bullish on expectations, or maybe better put, a little less negative on these expectations. So hence the market is reacting to that and starting to pick up. Now, we do feel that the market is getting a little bit ahead of itself right now, at least in some areas, and it may be a good time to take some profits in those areas or to just be cautious where you are investing. And that gets a little bit deep and a little bit more wonky, not really for this video. Thanks for watching. Keep your eye out for our next video. And remember, at Leelyn Smith, we try to reach client goals with the least amount of risk possible.